There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Traders, depositors worldwide, my name is Steve Federal. This is the Auvoria Prime, let's just call it the Monday morning after the potential disaster video podcast. So I'd like to just let everybody know today's the 13th of March. I'm going to be talking a little less enthusiastic today because I'm not feeling so hot. I think the ocean beat me up over the weekend, but did want to kind of address, I haven't done any of these casts in a couple of weeks, and I think it's probably a good opportunity to kind of go over what's going on. So one point of reference I want to make note of here is that if you're going to listen to anybody talk about what's going on, make sure that this individual is, I don't know, I guess for lack of a better term, vetted out. I guess I would hold myself to the same type of fire, but make sure they're vetted out. Make sure that the person you're following understands what they're talking about, because I can tell you in this whole sort of like partially invented banking crisis, it really is the bad deeds of just a couple of mid-level, regional, in some cases esoteric venture capital bank, and I'm speaking about Silicon Valley Bank, SVB. Probably many people don't know who they are, but been quite in the news. A lot of regional banks like Regions and Synovus, that kind of do this type of thing, maybe not in the rotten risk management era that was essentially the whole crisis and how everything played out. One of the important things to understand about all that is that looking at over the course of the last week, it's been a lot of sort of soul searching at how this all plays out. And let me just share a couple of screens here on this I have. I think the key is with this, it's just looking at, what's going on with all of this. Let me just share the screen here. I don't really want. It's the Forex Factory calendar. I know you guys have come here for just what's sort of going on in currencies and so forth, and I'll address that. Do make sure you note that all your clocks and your trading systems and stuff have changed to March 12th, which was Saturday. This is the U.S. and Canada. I think Europe falls in another week or two. But we have the big CPI readings tomorrow. This is going to be pretty important. So let's pay attention to this. Obviously, this takes considerably less center stage as the whole banking system has taken center stage, and so forth. But the reason I mentioned, follow folks that know what they're talking about. You guys can certainly go to the home page of Twitter. You can see who I follow. Many of the followers I follow that are in the region of smartness, guys like Peru, certainly the just different Sven Heinrich, so forth, Carlos Casio, you can see him in here as well. There are people that understand what they're talking about, because many of them worked in credit or derivative based businesses, or in one case an actual hedge fund. So essentially what happened. Just looking at the bond market rallying here in terms of the iShares 20-year bond ETF. But essentially what happened is Silicon Valley Bank went belly up about 30 hours last week. It really isn't anyone's fault other than just a whole mess of concentrated bad market risk and a whole bunch of just poor investment management, in my opinion. So a $200 billion balance sheet bank went down so fast because they basically bought a ton of short-dated treasuries in the portfolio, and most of those, obviously with the flip or the spreads that they had set up on them, they took really large losses. And the problem with a lot of regional banks is that because they have deposits, they don't have to mark to market their portfolio each week. So they can get away, especially in the case of SVB, get away with having very poor investment management that was quite known to a lot of the biggest players that were shining a light on this almost a whole quarter ago. Guys like Marco Hedes and so forth that took a lot of flack for this, but were totally dead right in the end. So it really boils down to just disastrous risk management, which is really the core of what I try and have a lot of these podcasts about. But essentially what SVB did with their investment portfolio, it's either a signal of enormous incompetence or just outright moral hazard, right? I'll let you guys sort of be the judge on that. I'm not really here to say anything other than I personally think at some point, which is a totally contentious and certainly a controversial theme, that banks, if they have certain reserve requirements or the potential for a bank run, they probably should at least do a quarterly mark to market of their investment portfolios, right? It's going to hold a lot more of them to the fire because it's going to force them to make more conservative decisions with the capital of the bank, right? So instead of betting it all, and as you can see, as I often will illustrate, the yields, which have absolutely been ripping in the credit markets the last couple of days, is because of simply, price has been absolutely ripping in the credit markets because, during any period of risk management, there is a flight to safety. And so in this particular case, this flight to safety has gone into mostly short-dated treasuries, 2 years typically, but we're looking at a little longer-term instrument. But I did want to at least show how price movements can be quite dramatic in that arena. So, I'm not going to get too much into all this today, but I did want to note on a couple of things. So, so the concern I really have with all this, and I don't think anybody in Washington is going to figure this out. I mean, albeit, certainly I would imagine there was meetings in galore across everything, FDIC, Treasury, a lot of the bank heads, risk management departments over the weekend. I mean, they came out and decided to backstop depositors and let all equity holders get wiped out, right? This was different than the bailout, if you will, during the global financial crisis. So during GFC, everybody was made whole depending on the bank, and the exception of the stockholders for a couple of large banks and brokerage firms like Lehman and Bear Stearns that went down in flames. But just looking at what the aftermath of Silicon Valley's, based on the value of their assets, they were technically insolvent last quarter, and they had leverage of somewhere in the area of 185 to 1. So it seems like almost like the average person say, well, if this is a really striking occurrence, from a mark-to-market basis, they were basically broke last quarter. But they were still liquid because liquidity matters, and one reason banks aren't required, as I've mentioned, to mark assets to market is that they can hold them indefinitely as long as they have deposits, right? So on the other hand, Silicon Valley Bank's deposits were less sticky than other companies, since they were providing by mostly money-burning companies. The lack of mark-to-market accounting is a reflection of general banking reality that banks don't get explicitly margin called by customers. They do sometimes experience runs, and it would take an absolute titanic bank run to actually impair the company's liquidity. So a run is unlikely, and even if the company did run into trouble, there are good political reasons to think that deposits wouldn't be harmed, right? So people who donate, go into this. So the problem that I see it is that any kind of bank, especially in Silicon Valley Bank, especially that type of group, and there's a couple of banks in New York that were taken over and so forth. But I think the real concern from just the general marketplace is that, hey, will these banks, will it be a systemic risk? Will it move out to others, right? So I would think that if you're going to start to pull a wool off of any potential problems in the marketplace, you'd want to look to banks that have the potential for a fast run. So SVB had a potential for a fast run because, the bank's digital. They had a lot of high technology that allowed a lot of their depositors. Many of them were big big venture cap based startup tech companies, right? So they have the ability, especially with the instant digitization of money movement, to pull just huge chunks out, and that's what happened. So essentially, it was almost like a big digital bank run over the course of the last week. And there's far smarter people out there that are diving into this much deeper than that. And I don't really want to get into it over any of last week because, frankly, I wanted to see how it was going to play out and what political waves, if you will, were going to position this. But the beauty of this from just a common person is I think that now a lot of banks, especially regionals, that are maybe under fire, one of them, a lot of their stock pricing is probably in a value orientation now. But I think everybody's going to take a hard look at, how they built the portfolio. And keep in mind, this is also a symptom of a massive rate increase by the Fed, right? So it's shifted the risk around a lot in billions and billions of dollars of portfolios and how a lot of these banks are structuring, right? So a lot of people say, well, hey, banks are forced to, by the GFC rules, invest in much safer stuff. How can this have happened, right? And it had a lot to do with leverage and, basically the wrong assets bought. And honestly, if you just look at it from just a general stability standpoint, if you own $10 billion in 2% paying treasuries, wouldn't you move to either swap or trade those portfolios around to get to the current treasuries, right? Some are paying 4.5% to 5%. So wouldn't you rather have that, play out? So, I would. So, I would just want to move the portfolio to a higher yielding current liquidity, and there's a lot of liquidity to a lot of the 2-year treasuries. So I don't want to beat the dead horse in this, but a lot of people say, well, why do banks buy all these bonds? And regulators basically force banks to own an amount of highly quality, highly liquid, they call it HQLA, at least big enough to meet a stressed outflow of deposits for 30 days. So it's what's called a liquidity coverage ratio above 100%. So you guys can look it up if you want to see that, but the qualifying corporate debt and RMBSs and debt securities, they all sort of fall under that level 2 assets that the bank has to hold. But if there's a huge change in interest rates, it brings in just an inordinate amount of new risk that enters in the equation, and it is very simply, in my opinion, interest rate risk. So, but that's kind of where I wanted to show you guys here. Let me just take a look at the markets as a whole, since we really haven't touched on equities right now. Just look at the S&P for now. These are daily charts, okay? So we're rallying back a little bit from just the absolute hammering we've taken over this period of time. One thing I will note, let me just see if arguably that's probably too much time frame. But if we look at it can even arguably take all this out up here. I don't think it's going to change it much, as you can see. But the market held really well to the value area highs and lows of the S&P 500. So we still could go back down. No surprise that the value area low was the low that we saw last summer and into the previous low at the end of the October, essentially beginning of the third quarter lows in the market. So ultimately, I still think this is where we're going. We're going to get out here and test. There's a lot of missing notches. I'm not going to get into the missing auctioning process that sort of needs to be fixed in any of these, but ideally this is why we have, with a lot of clients at first down and new clients coming in, we're fortunate to convince them to take a lot off the table up here, at least in the equity portions of the portfolio. For some of our oldest clients, we'd much rather sift through lower stock prices, should that in fact play out, than we would, trying to, use the diversification argument. So you'll see a lot of investment managers to say, well, you want to be diversified, and that spreads out risk. And while that's a good concept and it is a core tenet of financial management, what we believe that's different is that if you do see overwhelming risk, as we have since January of 22, in the stock portions of the developed markets globally, emerging markets are doing much better, obviously, but for the standpoint of that, we just don't want to have a lot of large exposure in this area. So there's ways to have this kind of exposure, by the way, and not have the risk associated with it too, if you're not familiar with what a fixed indexed annuity is. So that was the book that my partner Steve and I just wrote on that arena. If you guys want to get a closer look at the book, you can go to the website, so forth. In any case, so that's where the S&P is, kind of my thoughts on that. Talked about bonds, obviously. Let's take a quick look at the dollar. Again, this is a daily chart. I think, and I'm going to say the currency markets haven't certainly forgot about this, but they've been a little bit calmer than I would have expected based on what's gone on in the last couple of days. I mean, obviously the dollar's pulled back, almost in a direct correlation, if you will, to the absolute rip in the price of treasury bonds across all durations and maturities. I would continue to see if that is in fact the case, and there is a flight to safety, which is typically in treasuries. You'll probably continue to see this play out in more of a decline of the DX, the DXY, and so forth. So that's kind of where I am as far as wanting to, get more involved in it. But the hard floor on DXY and the dollar, which is in this particular case is an amalgamation, mostly euro, but other factors and currencies. But 100, pretty much the floor. At the top, where we were up against, just under 106, I expect to be the high. Let's take a look at the euro as well. So British pound, US dollar, again, daily chart. I do want to look at the euro. So I always use last part of the third quarter and the beginning of the fourth quarter as a sort of a base for what I like to call parity. And since then the euro's value has moved up as the dollar's pulled back from what was an absolute monster run into the end of the third quarter last year. But now we've popped back up as the dollar's going down, obviously. I think that maybe part of the reason for the strength is, Europe seems to be, even with the global conflict, prices of energy and so forth have come down a lot. And I think that's helped a lot in terms of profitability and maybe even strength, just almost on the second reason for that, which was in a totally over crazy run in the dollar that's totally reversed, right? So for now, I think the path of least resistance is probably up towards that high just under 110. We haven't seen that in a long time. So I would expect it to go back and test this range again should the dollar continue down. So as far as the British pound, you can see, trying to look at just this lower portion data, which started essentially last June. So for the whole year we're looking at in terms of market profile, and you can see how the tops of this profile was very solid in the resistance. I can't say this line was at this particular point. Back during this probably was somewhere in the range of this when it's trading back there, but you can see where we are hovering right around this point of control center line at 120. But the top of this range being 124.30 area, the lower part of the range being, I would even argue, probably higher than the value area low right here, 118, somewhere in that range. So most of the bond ETFs are rallying. I think I can't really get into too much in individual stock land here. I think the big surprise for me just over the last quarter, if we're just reflecting on Q1 in equity land, has been the rally in General Electric, man. Who knew? Crazy. Just when you think that things are dead and fought and forgotten forever, GE comes storming back, man. That is a crazy good chart. I haven't seen anything like that in a long time. GE's climbing back from the doldrums this company spent just decades in, off of its stellar run in the 90s. Alright guys, so that's kind of where we are. I don't want to get too involved. I don't want to get too opinionated on this banking crisis other than describing what's going on, and that, I think we need to let cooler heads in the credit and banking space prevail throughout the week and see what plays out. But, for now, deposits are protected. I think this will probably help open up the discussion as well of raising limits on the FDIC, right? So I've been plenty of calls for that. Do note that most organizations, I can't speak for all banks, but of larger regionals and or the big four, which is JP Morgan, Citigroup, Bank of America, and Wells Fargo, the big regional brokerage firms, like Schwab, Fidelity, so forth, many of these guys have insurance that's far exceeds the FDIC. So you have SIPC, which is the Securities Investors Protection Corporation insurance that supersedes the FDIC. Many of these organizations, especially Schwab and Fidelity, have purchased additional insurance that helps protect the deposits. So and that's why I started this podcast off with, there's just all kinds of misinformation out there right now on what's going on, and pay attention to the people that truly know what they're doing. That may or may not be me. So, because honestly, I haven't really had the time to delve into this, as some people, especially some of the ones I follow on Twitter, have done a really good job of explaining it. But there's a lot of misinformation out there on this. So as I always tell people, one of the big tenets of risk management from the standpoint of is just getting quality information, right? Getting quality data from sources you trust that are good at what they do. And with that being said, I wish everybody a great week. As always, any questions, feel free to hit me up on Twitter, send me an email, what have you. You can hit me up on Telegram as well. If everybody has a good week, may the trades be with you.